Hi guys! This is the second series of videos, How to Start Trading as a Novice Trader from A to Z. In the previous part, we touched on the topic of psychology in trading. Psychology is a very important component of your success in the financial market. And if you are ready for serious business, then now we will dive deeper and deeper into the world of trading. Make yourself comfortable, grab some popcorn and soda. We begin. But before we start, I would like to say that, according to YouTube statistics, 92% of viewers watch my videos without subscribing to the channel. Therefore, I have a huge request to you to subscribe to my Pipsley Trade channel. Your subscription and activity in the form of likes and comments encourages me to create more useful content for you. If you are still a baby in the field of trading and don't really understand anything, then this trilogy of videos, How to Start Trading as a Novice Trader from A to Z, will be very useful for your further development as a financial guru. If you are watching this video, it means you are at least a little familiar with trading. This means that I don't need to tell you in detail what trading terminals, charts, and candles are, or introduce you to terms like sell or buy position, stop loss, or take profit. I hope I'm right. And if not, then don't be too angry with me, as this information will take a lot of time to get acquainted with. But in a nutshell, I will still touch on the understanding of the basic terms. A long position or buy position is the purchase of an asset at a cheaper price, with the goal of selling it at a higher price. Since price growth usually occurs with a long accumulation, therefore transactions to purchase an asset were called a long position. A short position or sell position is the sale of an asset at a high price in order to buy it cheap. Since sales mainly occur on negative news, they try to get rid of the asset as quickly as possible, which causes a sharp drop in price. A stop loss is an order that limits your losses on an open position. Using stop orders is very important in trading. Traders who do not limit their losses in an open transaction lose their deposit very quickly. Take profit is an order that limits your profit in an open position. It is set in relation to the rules of your strategy or the risk to profit ratio. Traders who inflate their expectations and are greedy with profits without fixing them, as a rule, close their transactions with a minimum profit or a stop loss. Price movement, formation of patterns. Price always moves in three phases: accumulation, impulse, and distribution. Accumulation and distribution are sideways movements or simply flat movements. At this stage, the major player recruits or disperses his main application. It is at this stage that a large number of manipulations occur that take away the positions of small market players. No one knows 100% in which direction the price will go out of the sideways movement. Impulse movements are the price reaction to the injection of large capital. The bank, having quietly gained most of the position in the flat, makes a test purchase of a financial asset, thereby provoking the price to exit the sideways movement. After an impulse, there is always a corrective movement to throw out the smart guys who went in the right direction from the market. Also, at the end of the impulse, banks fix part of the position in profit, and at the end of the correction, they purchase again. This is how banks and other financial institutions make money. As profitable traders, we are interested in the impulse exit from the sideways movement and the end of the correction to this impulse. To correctly determine the zone in which it will be more profitable for us to enter the market, we will need the Fibonacci grid and its 50%. To determine 50% of the impulse movement, you can also use the rectangle tool or trend line. Just stretch them from the beginning to the end of the movement, and they will show you half of the wave. All impulse movement is divided into premium and discount zones. We are only interested in the premium zone for sales and the discount zone for purchases. Now, we just have to wait for the price to enter the premium zone and the formation of a reversal pattern. Now I will show you a graphical sketch of all types of reversal patterns. To make it easier for you to determine the formation of patterns, you definitely need to know the formation of the correct OCATs, or swing formation. You will find a video with this information on my channel. It's called market structure. Having waited for the formation of a reversal pattern, we calculate the risk, which should not exceed 2% of the deposit, and open a deal. Be sure to set a stop-loss order and take profit. The main goal for profit will be the end of the previous impulse. If you see potential for movement, you can split your order into two parts. Close the first part of 80% at the end of the previous impulse and leave the remaining 20% until the goals you define. Why is it so important to wait for the price in the premium or discount zone? The statistics of my transactions show that a correction often consists of 3 or 5 corrective impulses. And the first of these impulses also ends in a reversal pattern before reaching the 50% zone, and in the end, the transaction ends in a loss or small profit. I will give you some important tips that help me become a profitable trader. 1. For the main time frame on which you will watch the formation of impulses and corrections, take an hourly or 4-hourly one. There is no need to be shallow and sit on minute charts. This is very difficult in terms of psychology. A low time frame means a lot of signals and a lot of trades, among which most of them will be unprofitable, and this includes the desire to get even. 2. To look for reversal patterns, use a 5-minute time frame. 3. Do not jump from time frame to time frame. This distorts the overall picture. 4. Don't chase deals. 2 to 3 trades per week is normal, but on the other hand, they will be systematic and deliberate. 5. Don't catch trend reversals. Statistics have proven that 80% of the trend will continue. 6. There is no need to trade all currency pairs that are in the terminal. The more pairs, the stronger the defocusing of attention. Also, the more pairs there are, the greater the risk. 7. Take 1-3 currency pairs, ideally 2, and only trade them. 8. Don't bother trading gold and indices. They are very volatile, and it will be extremely difficult for a beginner to deal with them. I'm sure you liked this video and have already liked it. You will also listen to my advice because it was written in the blood of many traders, including mine. Good luck to everyone, good health, and more profitable days.